At the end of the Federal Reserve's policy meeting in January, we got confirmation that rate cuts are on the way, but maybe not as soon as some thought it would be. In today's video, we're going to look at the Fed's latest interest rate action and statements and what that could mean for mortgage rates and the housing market in 2024. Let's get into it. At the end of the Fed's recent policy meeting, they decided to maintain the level of their Fed funds rate. No rate increases and no rate cuts. But that's not what was most telling about the recent meeting. What mattered more is the change in language in their official statement. In the previous Fed release after their December meeting, they had this in their statement. The committee will continue to assess additional information and its implications for monetary policy in determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over the time. The committee will take into account the cumulative tightening of monetary policy. The key words in that statement were additional policy firming, meaning at their December meeting they were still thinking about tighter monetary policy such as further rate increases. But that statement didn't appear in their January press release. Instead, it had this. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. The difference between the two statements: the December release was still talking about policy tightening, but now the January release indicates they are now discussing reducing their Fed funds rate. This was confirmed in Fed Chair Jerome Powell's press conference. Powell indicated that their next meeting in March may be too soon for them to start reducing their Fed funds rate, but he also said that rate cuts could start at some time this year. If rate cuts are not going to happen at their next meeting in March, as Powell indicated, then the next opportunity for a rate cut would be at their following meeting that ends on May 1st. So, what does this all mean for mortgage rates? The best indicator to look at for that is the 10-year Treasury yield. The prospect of lower rates in the near future was well received in the bond market as the 10-year Treasury yield reached as low as 3.86% in market close on Thursday, February 1st, down from the recent peak of 4.19% on January 19th. This may not seem like much of a move in the short term, but it was a reduction of almost 0.3 percentage points in just 2 weeks. When the rate cuts finally happen this year, we could see a sharper decrease in the 10-year Treasury yield, which would then send mortgage rates sharply lower as well. The two rates are highly correlated, as you can see from this chart here. The 30-year fixed-rate mortgage follows the 10-year Treasury yield nearly in lockstep. In my last Mortgage Outlook video, I highlighted how we could see mortgage rates reach 5% or lower this year if the Fed follows through on its expected rate cuts. This all depends, however, on how the bond market reacts to the Fed cuts. Historically, the 30-year mortgage rate has been 1.8 percentage points higher than the 10-year Treasury yield. So for mortgage rates to get below 5%, we would need the 10-year Treasury yield to reach around 3%. Given what we've seen in just a few weeks of market action, this is a very realistic scenario. As I previously mentioned, the 10-year Treasury yield came down 0.3 percentage points in just 2 weeks on the prospect of a lower Fed funds rate, and we could definitely see multiple rate cuts this year if inflation continues to head lower and the economy doesn't overheat. The big caveat here is that all the economic data would need to continue to trend as it has the last few months. Now, what does this mean for the housing market? A 5% or lower mortgage rate would be exactly what we need to get the housing market back into action. For the last year, the U.S. median home price has trended sideways for the most part, as real estate throughout the country is largely frozen. New home listings have cratered as fewer homeowners want to sell their house just to buy another house with a higher mortgage rate. And buyers have been dealing with some serious affordability issues. The average housing payment as a share of the median income is at historic highs. But if mortgage rates came down to 5%, even if home prices stayed the same, the average housing payment becomes much more affordable for the average household. Ultimately, a lower mortgage rate would stimulate demand, which would put upward pressure on prices, but they aren't likely to go too much higher because we could see more supply coming online as well with new sellers. This is good for buyers and sellers and the economy overall. I'll be providing another update on the outlook for mortgage rates after the Fed's next meeting in March. So if you want to stay up to date as it all happens, make sure you are subscribed to this channel and hit that notification bell down below so you won't miss my next video. I also post videos on the housing market in the US overall, regional housing markets, and the direction of the US economy and how it impacts the housing market. Lots of great content coming out you won't want to miss. And if you found this video useful or at least mildly entertaining, don't forget to hit that like button on the way out to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.